How does a workman's comp insurance work? Workplace injuries, another boring topic I know a wee bit about. Let's go over some random interesting things about work comp WC. First, most employers are required to pay into a state-specific insurance fund to pay for employee injuries. You know that poster in your lunchroom? The one that says, if you are injured on the job, call this number or see these doctors. They are known as worksite posters, or panels, in WC parlance. There are two types of injury claims. Indemnity IND, or medical only MO. IND pays percentage of your wages if you cannot return to work. MO pays for medical care only, and you return to work. Note that you must miss about a week of work before you qualify for IND payments. Don't fall asleep yet. It's getting more juicy. Typically your company's WC claims are handled by a TPA, third-party administrator. You call the number on the worksite poster, and an adjuster will open a new case. You talk to nurse triage team on phone, and they decided if you should call 911 or go visit a clinic. All 50 states have different rules. Some states require that you only see doctors in the approved WC network, while other states are self-directed, meaning you can see any doctor. Based on this, adjusters set cash reserves on your claim to match the level of expense needed for the life of the claim. They produce monthly loss run reports to analyze reserves versus incurred actual expenses. Litigated claims cost a lot more. The sooner a TPA talks to an injured worker, the lower the chance that an injured worker sits around stewing and calling lawyers. God, so boring. Wake up. I swear, this is getting better. There are large companies that prefer to be self-insured. In this case, they have a known quantity and cost of injuries yearly and think they can save money running themselves. For example, a chicken farm might be fairly sure that annually they will have 75 people slice their thumb and need first aid, 5 people lose a finger, and 1 person falls into the vat of chicken tender mixer and dies. Actuaries are required to calculate the minimum cash reserves for self-insureds. At the end of the fiscal year, self-insureds are required to submit an SEER self-insured annual report to the state that shows all reserves versus payments for the past 5 years. It looks like this. Paid means actual payments, which does not necessarily match incurred, and future liability is exactly that, reserves set aside for known future payments. Part of the taxes you pay out of your paycheck go to workers' comp coverage, and your employer contributes as well. Anything that can happen to you on the job can be considered workers' comp. If you're horsing around and basically bring it on yourself, there may be some questions involved. When I was working in doctors' offices, it was really difficult to get workers' comp to pay for anything that wasn't an out-and-out broken bone or some other physical injury. We had a patient come in for a stress test, treadmill kind. He was 100% clear. The next day, during a difficult situation at work, he had a heart attack. That one ended up being easy because of the stress test, but if not, that would have most likely been hung up for years, as those tend to do. Workers' compensation insurance is the original no-fault insurance. The employer is required by law to purchase WC for its employees. Every state requires WC, and so some rules may vary. Some states, Ohio among them, have their own fund, so you are buying the insurance from them and not from an insurance company. The rate varies by what the employee does and is expressed in dollars per $100 in pay. So the rate may be, say, $3.25, which is $3.25 per $100 in pay. If there is an accident or injury in the workplace, the employee goes immediately to the hospital or urgent care to taken care of. That's the no-fault part. The most important factor is to care for the injured employee. Investigation is important but secondary. The law stipulates the amount the employee will be paid during their time off, and there is also an accidental death and dismemberment profusion that pays in case an employee dies or loses a body part.